Ladies and gentlemen, the herd of stock market bulls have just awoken and they are charging forward. What I mean by that? So please watch on, especially until the end of the stock market analysis that I'll provide you the entire insight. So over the last long weekend, a lot of things have happened. The stock market has hit some interesting numbers. The core PC inflation data has just been released and it's interesting information. Jerome Powell on Friday gave a speech and there are interesting insights you all need to know. Putting all these things together and distilling to some interesting insights that I just saw, this came to the conclusion about the whole herd of stock market bulls have just awoken. So you need to watch until the end to get the main conclusion and don't miss the end. So as usual, these are my usual disclaimers. Please watch them and read them. And let's go. So the PCE inflation data has just came out, and this is the preferred inflation gauge that the Federal Reserve used. And thank God the number came out in line with economists' expectation, and that is a slowdown from January increase. So in January, it went up by 0.4%. In February, it went down to 0.3%, right? And that's extremely good. And that allow the analysts and the Federal Reserve possibly to come back with a mid of the year interest rate cuts again. But right now, the stock market is pricing lesser interest rate cuts than what they have used to, which is good. They are more realistic right now. They are looking at 2 to 3 interest rate cuts towards the end of the year. And whether this will result in any retracement is yet to be seen, but it could happen. I don't think at this juncture we should see any big kind of pullback because of this information. But the whole stock market is unpredictable, so be ready for any surprises. It's looking right now as a okay kind of inflation environment and possibly a comfortable interest rate cuts moving forward. Interestingly, Jerome Powell came out on Friday and gave an interview in the San Francisco Federal Reserve Bank conference called the Macroeconomics and Monetary Policy Forum. For those people who are game for a very powerful intellectual stimulation and a very deep economics lesson, I invite you to watch the interview. You will actually find it quite interesting. But for those who are just interested to know the implications, you can watch my channel. So Jerome Powell, the Federal Reserve Chairman, gave a light hint, light, not heavy hint, light hint that the Federal Reserve is prepared to delay interest rate cuts. That generally is not a good news, but as I said, it's a light hint, it's not a heavy hint. In the talk, he reiterated that there is a success in bringing down inflation, and the last 2 months of inflation data should be looked at as a part of a bumpy road downwards. So the January inflationary bump was quite high, but February came down a little bit, not enough in his words, not enough to be happy, but still it's comforting to know that it's coming down. But he also stressed that in the event that the inflation rate do re-spiked up again, the Federal Reserve is ready to deal with the situation. In short, they are ready not to cut interest rates. A few quick points of what he said. He said that inflation has now cooled down largely due to supply side healing, right? Which is basically a sophisticated way of saying that all the supply side disruptions, shipping disruption, logistic disruption, factory disruption caused by COVID are now slowly and beginning to open up. Those problems are now over. Therefore, supply and demand has now met, and that's a good thing. With now inflation down, the Federal Reserve can now think of the dual mandate, which means that they have two responsibility. One is inflation responsibility to keep inflation rate, at a comfortable 2% or lower. And the other responsibility of the Federal Reserve is to make sure that unemployment is kept low. So this dual mandate during the last 2 years was this way, which means that the pressure of the inflation rate was high. So they ignored the unemployment problem. They dealt with the inflation one. Now that this thing has kind of come into closer balance, they now should think about both this objective. And that's a good thing. This is his way of saying, I cannot just keep thinking of increasing interest rate or keeping interest rate high to bring down inflation, but I now need to think of, if too high inflation kept for too long will cause more unemployment, right? He also said that, hey, US right now is experiencing a strong economic growth, super powerful economic growth that rest of the world is not experiencing. And therefore, there is no rush for him to cut interest rate. That's his hint, right? So if necessary, he's prepared to hold back the interest rate cuts to make sure that the inflation really come down. That's not a happy sign, but this information is not new information. He said it many times already, but he kind of repeat again. So I think it's just an additional voice that he remind everybody don't over celebrate. An interesting point that he also stressed is that even if the inflation rate would come down to 2%, we should all expect now interest rate to be stabilizing at a higher interest rate than what we experienced over the last 10 years or so. Last 10 years, a lot of interest rate was very near to 1 or 0%. He basically says that no, those days are likely to be over because he wants to keep a buffer of interest rates in case there's a recession in future. There's room for the Federal Reserve to cut, right? So they're doing a lot of forward planning, which I think it's a very good thing, which also means that those people who take loans, you have housing loans, you have got car loans or things like that, those things unlikely to go down too much, which also means that those fixed D rates, T-bills and all this are likely to be higher than what we've seen long time ago. So there's pros and cons depending where you sit. The last thing which I think he said, which kind of draw a hint to everybody about when the interest rate cuts will be, is this thing. He emphasized again that the Federal Reserve cornerstone and pillar is all about integrity, integrity, integrity. And if the people have lost trust in the Federal Reserve, then the whole system will not work. He kind of implied that, whatever I say must hold weight. So the Federal Reserve have made certain statements before, and those statements we should take it quite seriously because he reiterated that it's all about integrity. So he basically says that if the inflation rate continue to go down, he should see interest rate cuts somewhere to the middle of the year and possibly 2 to 3 interest rate cut to the end of year as the dot plot implies. So I think those kind of projection will still hold. Now, for the most important news of the day, this is the key analysis. So even before Jerome Powell came out and made those statements, and even before the core PCE inflation data has came out, the stock market has hit an all-time high. And let me stress, again, he has hit the all-time high, again. The S&P 500 has hit 5254 last Thursday. Friday was a holiday, and this was a great rise. But that is not the key thing I want to drive at. The key thing I drive at is what caused this thing to rise if you were to peel the onion and see what's inside. The S&P 500 is made up of 500 stocks. For the last 1 year plus of bull run, it's all about 7 stocks, 7 high-tech stocks, mainly the Nvidia, the Facebook, Google, Apple, to some extent at that point in time was Tesla. So all these stocks were rising like crazy and lifted the whole stock market, S&P 500 up, whereas the rest of the S&P 500 stocks were all lagging behind. Most of them didn't even increase at all, okay? And some even went negative. So it's basically S&P 7 versus the S&P 493, right? That goes this way. Interestingly, recently, Apple and Tesla seem to falter a little bit, but take note, this is where the herd of bulls have just awoken. So the stock market, since the start of the year until now, if you peel the onion and look at the various sectors, many of them are registering high double-digit growth. And these double-digit growth are very significant. Even month to date, by looking at March, most of them are registering very strong single-digit growth. So we are now in a situation where the subcomponents of the S&P 493 are now lifting up. So the herds have now finally awoken. We've been waiting for them to wake for a long time. So if the whole herd is awakened, okay, and they will charge forward like what we're seeing right now, what do you think the whole stock market will be? It's a fantastic news, right? Don't listen to what Mr. Loo said. Look at what the analyst says. The economists and analysts right now are revising their S&P 500 target for the end of the year. Right now, a few of them are forecasting 5,500 points to the end of the year. This includes Oppenheimer and SocGen, okay? Bank of America Yardeni and Barclay are all projecting 5,400 and 5,300 points. These are not just the banks that are making this prediction, because there are a few banks that hasn't submitted their reforecast or haven't made their reforecast. Funny to say that we have still JP Morgan and Morgan Stanley still predicting that it's 4,200, 4,500. In short, they're predicting a crash. Maybe it happened, maybe not, I don't know. Okay. So I'm in line closer to the prediction of 5,400-ish or so. And if you look at it, 5,400 points from now is only about 3, 4, 5% growth only. So it's very little, right? And it could be a 1 or 2 days price movement or 1 or 2 weeks price movement with a very good news that happened. So I think right now the whole stock market awoken and now charging forward. The likelihood of us seeing big numbers at the end of the year is very high. So this is a great news, right? It's a great news. So just a quick word on NASDAQ. Interestingly, as the S&P 500 rocketing up, the NASDAQ has kind of hit a plateau, right? You can see. So this is also indicative that right now is no longer about high-tech stock going up. Okay, so the rest of the stocks are going up are usually the non-tech stocks. So this is called a musical chair, right? So the money has flowed from high tech right now to non-high tech. So we should expect the NASDAQ to have some slowdown in the growth. Doesn't mean the NASDAQ will crash, but as we see right now, the high tech stock are not so high in favor for this month. Okay, it's kind of flattish, even though the S&P 500 is breaking new highs and highs and highs. But I wouldn't consider that this is indicative of a long-term trend, because we still have an AI boom. So whatever good news that we'll see from AI side will cause this whole thing to have this dramatic turn up again. So I think we should see a point inflection in time to come as the AI boom continues, right? We now have a good news that S&P 500 is going up. That's lifted by the whole index and not just the Magnificent Seven. And we have also a NASDAQ, in a point of plateau, but the AI boom will most likely cause it to a point inflection and go up again, right? So I think generally we'll see some overall good news in both the NASDAQ and the S&P 500 in the short to mid-term. So in a nutshell, over the last few days, the core PC data has came out and it's a good news. The Federal Reserve Chairman came out and give a speech. Nothing out of the world bad news have been released. So that's in some sense good news as well. And we have also analyzed that the current stock market new all-time high has been achieved is no longer led by the Magnificent Seven, but now uplifted by the whole base of the rest of the stock market, and that's a great news, right? So with this, thank you for watching. Let's join us also in our Telegram group, where we will discuss many of these stock market and wealth creating opportunities. Remember, like and subscribe, and I'll see you in a day or two. Bye bye.